Thank you for being here today. Let me first introduce myself. My name is Andrey. I'm CMO at STON.fi. STON.fi is the largest DEX on the STON blockchain. And today our session's title is Active Capital Beats Passive Liquidity. So quite often we hear this phrase, but I believe that lots of people there understand it differently. Plus, it depends on how you define active and passive because, well, it really depends on how you define the terms, and sometimes there is something in between, or as we discussed with Kingsley at the backstage, there is always something in between. So I think we can dive deeper into that today, and hopefully we'll have a great discussion. So guys, please introduce yourself, and if you want to provide short take on how you define active and passive, active capital and passive liquidity, or if you want to, how you define what beats means. Like, what is that? Okay, so it's up to you. Feel free to tell us anything you want.
Sure, happy to go first. So Kingsley Advani, founder of Allocations. We oversee $3 billion in assets, and we have an investor group with 150 crypto whales. We've done about $1 billion of farming volume. Some of the protocols we've used over the years, I've got a list because I can't remember all of them. Compound, Pendle, Curve, Aave, Yearn Finance, Morpho, Lido, Hyperliquid, Aerodrome. Recently we did Babylon as well. So we've used all different types of protocols. And I would say we're in between active and passive in that we're not monitoring our positions every hour, and we're also not leaving it in for a year without touching it. And we have a Slack group where we can alert each other. We have a red alert channel if there's a hack. And so we're constantly comparing which yield strategies each other's using, which pools have the best APY. And so I'd say we're somewhere in between active and passive for our yield strategies.
Awesome, thank you.
Hello everyone, my name is Lingling. I'm the partner of DWF Labs and Falcon Finance. So DWF Labs is a Web3 investor and a market maker. We've been in the space since 2021 and worked with more than 1,000 projects. And Falcon Finance is a stablecoin protocol incubated by DWF Labs. We have almost $2 billion TVL, and we also launched our token launched on multiple centralized exchanges. Regarding passive and active capital, I will use Falcon Finance as an example. So we see two typical users using Falcon Finance. One is a passive. Basically what they do is just mint USDF, stake with us to earn a yield we provide for our users. And then active users, they mint USDF. Instead of staking with us, they will actively go out looking for different opportunities, like a Pendle trading PTSD or looping on oil market, Morpho market, in hoping to beat our baseline yield. Yeah.
Great, thank you.
Hi everyone. My name is Alice. So I'm from Amber Premium. Amber Premium is the NASDAQ-listed subsidiary of the entire Amber Group. So the core of what we do is provide private banking-like services to our ultra-high net worth and institutional clients like family offices and so on. So we have over 1 billion of trading monthly volume and serviced over 4,500 of these type of clients. In regards to active capital and passive liquidity, I'll give something more metaphorical, right? So active capital could be something like the driver in a race car, really navigating and approaching that finish line. Whereas the passive liquidity can be the engine, so supporting the foundation of the entire car. So similar to what we do when we translate that to Amber Premium, the active capital side is really more on the type, depending on clients' appetite too, right? Depending on what they like to do, then that would be across different, say, option strategies, structured products, and so on. But the passive liquidity then is providing that fixed income, yield farming, bearing income for them.
Thank you.
Hi everyone, my name is Robert. I'm a head of research at Edge Capital. Edge Capital is one of the largest market-neutral hedge funds in the space. So we're running about like $500 million in assets under management. We're extremely active in the DeFi space and doing a lot of trades across DeFi and CeFi space. So we're actively deploying into all major DeFi apps, Hyperliquid, doing a lot of perp dexes. So we are pretty much on the active liquidity side. So I, together with my team, we're managing the portfolio, looking for the trades in a market neutral way. So I believe in DeFi specifically, actively managed liquidity is something which tries to beat the average market returns. There is a lot of debate on what do we define as the average return in DeFi. Some they say it's a funding rate, it's like the average rate on Athena or on Morpho markets. And basically, active liquidity is trying to beat those returns by actively deploying the capital into the most risk-adjusted opportunities, both on-chain and off-chain. So this is what we're trying to do in our fund. And yeah, I think it's extremely important to have both passive liquidity and active liquidity in DeFi and in crypto space overall, because it's something which drives the market overall. And yeah, I believe it's extremely important to actively manage liquidity in DeFi specifically, since there's a lot of nuances of the active managed strategies.
Awesome, thank you. So basically, we have some definitions, I would say, of active and passive, and but what I'm hearing is that these definitions, they can also depend on not just what you are doing with the liquidity or the capital, but who is doing that. So because I think that there are different approaches, that's what I have. Okay, so Robert started speaking about the definition of beats, because we have 3 terms over here, right? Do you guys want to add anything about how you define beats? So we say that it says active capital beats passive liquidity. Okay, but what do you mean by beats? Is that higher returns, lower down, lower drawdowns, or anything else? What do you think?
I think I can go first. So I think personally, in my own opinion, the word beat, where active capital beats passive liquidity, doesn't necessarily mean getting a higher return or controlling that drawdown. From what I think is more on having a resilient strategy across all cycles. So that's the word beat, right? So as long as you have a strategy that fits your own appetite, your goal, it should actually be resilient and overcome market cycles, whether it's bear, bull, or sideways, right? Yeah, that's what I think.
And when they say you, do you mean an end user and institution? Who's you, when you say that?
I'd say institutions, investors,
Okay.
more of actually the type of clients that we deal with, right? So especially as the advisor of their portfolio, we have to understand first, right, their appetite, their goals, their entire investment portfolio, and how these can actually cater to and actually manage them to become more resilient across these volatilities and uncertainties.
Awesome, thank you. Guys, do you want to add anything?
Yeah, I think a lot of people, when they compare 2 strategies, they will look at returns. That's easy. Oh, this DeFi protocol give me 15%, while Coinbase only 3%, right? They probably only compare return, but someone like me, I come from traditional finance background. One term always stuck with me, something called Sharpe ratio. It's called risk-adjusted return. So when you look at return, you also look at the risk you're taking. High risk, high return. That's just how it works. So when you compare 2 strategies, you just see how much additional risk you're taking and how much additional return you're getting. If in the end, the Sharpe ratio stays the same, I don't think it's worth doing all this active management for nothing.
So in these terms, does beat mean that it beats when the risk-return ratio is lower or higher?
Yes, so the risk-adjusted return is higher. Yeah, so you take additional, let's say 1% volatility, is your return goes by 2%, something like this. Yeah.
So that's how you define beats
Yes.
in these
Yeah, that's a
contexts.
very TradFi opinion.
Awesome. Awesome. Thank you.
I would agree with that also, that it's the risk-adjusted return that's important and the Sharpe ratio. Some of the new platforms that I'm seeing, you have some automated active managers like Arcadia. So I've recently went into a pool on there where they actively manage your portfolio for you, and they can harvest, they can rotate, and that can be quite interesting as a in-between, just passive and active. There's also insurance. So I recently purchased insurance on OpenCover. And so for some of the smart contract risk, you can actually purchase insurance for quite low amount of money. So in some cases, you can increase risk reward by having some insurance as well on your underlying positions.
Yeah, I pretty much agree. So I would say when everything goes well in the market, everyone starts thinking that beating the passive liquidity means just producing more returns, which is not fully true, right? Because like you need a risk-adjusted return. When the general users are looking into DeFi opportunities specifically, they're looking only into like the APY number, which is quite wrong, because the underlying risk can be much higher than just the return which you're getting for this. So this is why, yeah, again, like some of the DeFi opportunities, for example, some of the vaults might be higher risk, thus they're producing higher returns, but it might not be risk adjusted, right? So we're actually one of the largest curators in the space, and for example, some of our vaults, they may produce lower returns, but we're actively buying the insurance, right? Which is, of course, affects the price, affects the APY, because insurance costs some premium, but this is the price which you need to pay if you want to survive the markets like this, right? Because like in DeFi, there's been some pretty volatile times, like last half year, right? So there's been some stream finance event, 10-10 events, and it was a pretty good test for the environment to see who survived well and who did not. So yeah, and like I believe right now users and the market started being more vigilant and being more demandful in terms of the risk, which is, I believe, extremely good thing for the market overall.
Okay, awesome. Since we started speaking about the markets, do you believe that an answer to this question actually depends on the market conditions? Like we have bear markets, we have bull markets, we have sideways markets, and so on. So if we want to answer to this question, or maybe we don't have an answer because it's just like, the thing that sometimes might be controversial and so on, but do you think that the answer to this question actually, or what beats what, or what outperforms what, depends on the market conditions, or maybe it is always the same?
Yeah.
Feel free to jump in. Like we don't need to have any orders, so feel free to jump in, like guys. Okay.
Yeah.
Yeah, go ahead.
Sorry. I think it like this. The risk-adjusted return should be produced in any type of market, right? It's just like when you get a bear market, you got, of course, like you got lower returns,
Yep.
but you still manage the risk properly. Same in the bull market, right? So it's like you should not define your either you're active or passive, either you're high risk or not. It should not be defined by the market itself.
Yeah, but does it change depending on the markets? Does it mean that you have different ratios in, let's say, bull market and bear market? Should it stay the same, or do you adjust it?
Yeah. I think for sure. Like, for example, in our portfolio, when everything goes down, right, we're trying to be on a risk-off mode.
Okay.
So we're trying to like avoid all the riskier opportunities and seek more safer yields. Definitely.
Thank you.
Yeah, I think, when you you definitely need to keep in mind the risk-adjusted return. I think in bull markets or bear markets, that investors or users might have more opportunities when it comes to active capital. Like you can do, when volatility is huge, you have a lot of arbitrage opportunities. For us, we do sex to sex, sex to DEX, this kind of active arbitrage management. And during sideways market, when market doesn't move that much, just trade in a small range, I would say I personally prefer passive liquidity. Like you can do a stablecoin earnings now, like Falcon Finance, we around 7%. And then, or you can even safe choice, you can Coinbase just purely holding USDC. Coinbase give you like between 3 to 4%. So yeah, I think sideways market, I prefer passive liquidity, yeah.
I think building on to that, personally, I think is having a more of a balanced portfolio and strategy. Whether it's sideways, bull, or bear, active and passive, they actually come hand in hand. They actually complement each other. So building on to what Lingling said earlier, the stablecoin yield, as compared to traditional finance side, in crypto, you can potentially earn double-digit, minimum 8%, just for a fixed income, right? So you park that aside, and on top of that, you could actually be doing some structured products or options trading, for example, a sell put, where you earn that premium, you farm that premium, and then you use that premium to potentially buy BTC at dip, right? So there are different ways that you can navigate and play around with, as long as, number one, you have a strong conviction of the long-term view of the industry. Second of all, what you're doing now fits your own appetite and goal. You're fully aware of the risk and reward ratio. And last but not least, I think maybe we could talk about this later on as well, is finding the right and secure platform that helps you navigate and execute this whole journey.
Okay, do you think it's possible to find any kind of a benchmark or benchmarks for this? Like we can say that, let's say there is 5% like baseline or something, or 8%, but 10% risk or reward actually is fine, 20% is too risky. Do you think it's possible to provide any universal benchmark so that people just know when to know when to stop?
I'd put it in more neutral stance, but I think no, because it's quite hard to actually time the market, and sometimes the reward that you get is also dependent on the market, right?
Yep.
So what we always say, even Fidelity says, allocate at least 5% of your portfolio into crypto. Use that to actually just focus on what this market can offer to you, I think. Yeah.
I would say the benchmarks change depending on the market cycle. So you can rebalance your portfolio depending on whether it's a bullish, bearish, or sideways market. If personally, I've been in the hyperliquid vault, and it's been on about an 82% APY, and that was something that I set and forget about. Mm-hmm. I just left it there, and it's been compounding. And it's actually outperformed some of the more active strategies. So I think if you're going into a bear market or sideways market, it can be safer to set and forget. In a super bullish market, there's so many new protocols coming out, new opportunities, that you probably want to be more active because there's more yield opportunity. It is more volatile as well, so you have to be more careful, but you can rebalance your portfolio depending on the market cycle.
Awesome. And since we're speaking about rebalancing, do you believe it should actually depend also on the market conditions? So meaning, like, for example, you could say that in the sideways market, you need to rebalance it rarely, but in the bullish market, you need to do it more often and so on. What do you think on that?
We're in like a bearish market now, so I would say it's not as hot. There's not as many new opportunities for yield. I remember back like Q4 last year, there were so many different yield opportunities, and obviously there's been a bit less, and so I've rebalanced from more active to more passive.
Yeah, I also believe during sideways market, because market doesn't trade that much range, the big range, right? So rebalancing probably less often compared to when it's a bull market or bear market with like a huge volatility.
Yeah.
Yeah, I agree. So currently where we're at a more bearish market, what you said earlier, it's important to actually, enter into your portfolio and actually take a look, right? Because what you probably did a couple months ago when we reached that all-time high is very different to, the products that are available in the market, the return that you're getting. So it's definitely important to start rebalancing. And at the same time, with the, I guess, the passive liquidity side, I would always advise, right, just leave part of that where it gives that foundation bedrock to your portfolio. And then at the same time, then looking into different active strategies, not to beat this current market, but to at least lower your drawdown a bit, right? Manage that drawdown, I think.
Yeah, definitely agree. So I think like on the asset management side, this is exactly what the investors are looking for. So they're looking for asset managers who is able to navigate the markets and be more on the safe side while it's a bear market, more on the active side while it's a bull market. And I think currently, we're obviously in a bear market, but it's not as bad as it used to be a few years ago. Just because currently the rate is much higher, the interest rate, right? Like if you remember what happened like a few years ago, the rate was like almost at zero. So there was extremely low opportunity cost. And it was a bit depressing in the crypto environment because like if you're looking for safer yield, it was like almost none. Currently, you can use like Ondo or some tokenized T-bill projects just to be on the safe side because like even like a few years ago, I remember that there was almost no T-bill protocols on chain. So currently we evolved quite a bit. So it's much easier to navigate those markets right now.
So we start speaking about some more complex things. Do you think that there is a point when it doesn't make any sense to like to do to have these strategies too complicated? So you need to stop because adding more complexities will mean more risks and so on. Do you believe it is possible to define these points and tell exactly when one needs to stop? Maybe you have an example.
I'd just say there's more tools that can automate it for you. So Arcadia I've been using recently that does your active managed portfolio just like automatically. So you don't need to go in and out. It can auto harvest for you. I also think AI agents will help us a lot this year to generate more APY with less effort. Okay. So I think we'll have tools, we'll have Telegram bots that ping us, hey, this pool is at risk. This smart contract just got hacked. Let's get out of this pool. So I think there'll be more tools to help us be more active with less effort.
And when you say automated, do you mean some algorithms, or do you mean AI?
Yes.
Yes, what?
Both. Algorithms and AI, like looking at the technical, looking at the market if there's sudden shocks. Say in 1010, if you had some, automated stop losses or like sentiment bots that were running, you could have got out like quite quickly.
Okay, so it seems that there are some data sets that these agents, let's say some automation tool, can use to basically when you need to stop. But is it a black box for you, meaning that like for you as a person who has this automation, who uses this automation, like can you somehow understand why this tooling says you need to stop now?
Yeah, you have different agents. So you can have like a macro agent that looks at macro conditions. You can have a micro agent that looks at like technicals, technical agent, fundamental agent, sentiment agent. So you have different agents that are looking at different aspects, and they make a decision based on each of their parts.
Okay.
So you can see the reasoning as well behind it. I think AI agents will be very big for these types of DeFi farming strategies to help you manage risk.
Yeah, I think this we can still go back to like comparing different strategies, right? So adding another layer of trading or more complexity, how much risk, additional risk you're taking, and how much additional return you are gaining from this. If it's not improving your risk-adjusted return, I guess that's too complicated. Yeah.
Yeah. Do you think it is possible for, let's say, if you are not an institution, but if you are an end user, you're just a person who tries to gain some yield or something, do you think for them it is possible to understand all this stuff and to know how to find the best strategy in this case?
I think it's hard. I think people, when it's the end user, they probably mostly looking at the returns
Yep.
without looking the risk. So they
Yep.
probably just see how they can ramp up the return for themselves. Yeah.
Thank you.
I think building on to the risk part, no matter how great the strategy is or how much return it can generate for you, if the shop or platform that you're using for that execution isn't secure, in some way not licensed, not regulated, no transparency, this should be stopped, right? Because as the industry is getting more institutionalized, dominated, more recognized by the big players right there, we're also having different policies and act. The shops that are providing these services needs to be on par with these regulations. So yeah, like I said, right, no matter how great it is, but there's no transparency, you're exposed to these counterparty and wider risks, then that should be stopped.
I totally get it about transparency, but about regulation. Do you believe that this space should be regulated and yeah, should it be?
I think in some way it should, because like I said, I mean, even since last year, the space has been widely dominated by these key players, right? We have the spot ETF coming in, and these are the new capital that are coming in from the traditional side that has been long, in the industry, long in the field, right, in terms of legacy security. And these, in some ways, should be adopted into crypto. I think the core would be really safeguarding clients' assets. Yeah, that's key.
But does it mean that being regulated is the only way or the only approach, but there could be combinations, or maybe for some cases it can stay non-regulated?
Personally, I think, personally, I wouldn't say, it has to be 100% regulated.
Okay.
There's still a DeFi component there, right? So there's a market for everyone. On the DeFi side, crypto natives, those who have been in the field for decades, they are very much aware of this risk. Retail driven as well. I think for that side, it doesn't have to necessarily be as regulated as what we are doing now, right, with the Genius Act, licenses, and so on. But if we are getting institutional and new capital in, say, family offices, then in some way it should be regulated and their assets should be protected.
I would disagree on that one. I would say we should have some regulated platforms and some unregulated platforms. I think if you're two hackers two engineers in India getting started on a DeFi platform, you may not have the money to get a license, but you may be able to build a better yield strategy than some of the regulated platforms. So I think that obviously we will have those regulated platforms, but we should allow unregulated platforms as well. I do think, though, that the unregulated ones should be transparent, and I think we'll see things like proof of reserve, on-chain auditability, to make sure that they're solvent and they're not investing in random stuff. So they should be transparent, but we should still have unregulated platforms as well.
Yeah, definitely. It's like that's why the DeFi and the crypto space exists, because we need the freedom of creation of the projects just to evolve themselves. But from the other hand, of course, without the regulation, we will never see the big banks and big TradFi players in the space. So I believe it's the space needs some kind of a balance of both.
Just to add one more thing to that Hyperliquid is unregulated, right? It's for non-US users, but its derivatives volume is more than Coinbase. So it's crazy something could be created. They only have 11 people as well.
Yeah.
So with DeFi, you can create protocols like this that can surpass Coinbase's volume without any licenses.
It's interesting that this regulation topic is always a hot one. There are different takes on that, different opinions. But sometimes some people say that it should be regulated. Some people say that it should stay unregulated. But some people say that okay, I would love to see it like unregulated, but in some regions it's just not possible. And so real life is more complicated than this. And it's always what we can always discuss because it is interesting. Thank you. So do you believe, or do you think that there are questions that institutions ask, but DeFi just can't provide answers to these questions?
DeFi, sorry.
Like, so there could be institutions that go to, they go to you, let's say, and they ask some questions, and or they just questions in the air, but DeFi market, all the DeFi tools, market products, and so on, they just don't have answers to these questions. Regulation, by the way, I think it's one of them.
Yeah, institutions are more likely to go into the more regulated platforms. I know Coinbase have a bunch of licenses that the institutions will go with the bigger, more regulated platforms that can provide regulated products. So they're not going to be on, a very new yield platform that is offering very high APY, but they'll just be later on the adoption curve for that. But they are regulated as well, so they need to use regulated platforms. So institutions will likely use regulated platforms for this.
Yep. Do you think it's the only question they have, or maybe they have more? So we wanted to work it like this, or we have this question, but it just doesn't work like this, so it's a problem for us, for the institutions.
I think there are a few questions that DeFi cannot answer now for institutions. There is smart contract risk. That's pretty obvious one. Like billions of dollars have been hacked on DeFi. And I don't think we have found a solution to that because we're still seeing these things happening pretty often, right? And then that's also associated to the custodian side. Like right now, most of the DeFi, they keep the assets on chain, right? And I'm sure all these large institutions, they prefer using regulator-approved custodians. So how does DeFi integrate with this qualified custodian? I think this is a big question that haven't been solved. And I think if we can solve that, there are a lot of institutions would definitely come in.
Is it a question, to put it shortly, who to blame or something like, sometimes when we speak, let's say, different example, when we speak about AI, right? And let's imagine that some things go wrong. Whom we blame, is that
AI,
or its creator or no one?
Definitely the person behind the AI who created that AI, right?
I don't know.
I personally think,
I think it's
because AI cannot take responsibility for the things they do. They are designed by a human being.
Maybe.
Yeah.
But sometimes I think that in the future we will see that when this AI is designed by AI. So in this case,
when robots take over the world.
Singularity. It'll be different.
Yeah.
Guys, do you want to add anything on these questions that institutions ask but DeFi can't answer?
Yeah, I think just building onto, I think this links to the previous question, right?
Yep.
So building onto that, institutions are no longer asking why they should enter this market, but they're asking how, right? And this how is connected to questions around custodians, wallets, licenses, regulations, and then back to the point of DeFi, when there are so many different protocols that are coming every year, every month, institutions are less interested in that, right? They're looking for actually safe and secure platforms that can actually help them grow that long-term journey here in crypto.
You go.
Yeah, I just wanted to add that I really agree with the smart contract risk, which is you cannot estimate for now the amount of it on each smart contract. Take an example on Balancer hack, which was quite old smart contracts with a huge TVL, which got hacked, and no one, and everyone expected that to be a very safe yield. So it's quite a hard work for all the industry to bring those answers to the institutions. And maybe another question for them is the QIC issues, right? Because from the institution standpoint, it's very hard to make them deposit into some pool or some DeFi lending opportunity, and like while they might be in the same pool as some unregulated entity or even like North Korea or something like this, right? And I don't think there is a solution in DeFi for that. It's more like the institutions and the regulatory space should just accept this this feature of the DeFi markets, and I think we will get to that.
And accept how? So we can put it like this. So if,
I was just going to say how. I'd say we're less likely to see Ethereum deposit ETH into a DeFi farm, but more likely they invest into a DAT company. So we've seen a bunch of DAT companies, Bitcoin DATs, Ethereum, Solana, Athena, Hyperliquid, all different types, and we've personally invested and structured a bunch of them as well. That this way institutions can get synthetic exposure to DeFi, where each of these DATs have their own DeFi strategies to generate yield and reinvest in buying back shares or issuing dividends. That this has been the play like the last 12 months for institutions to get exposure to DeFi, not by investing in the pool, but by investing in DATs that have DeFi strategies.
do you want to add anything, guys?
Yeah, but that has been proved not successful.
Yeah, in a bear market, it's not a great strategy. But I'd say it's a trend that we're likely to see, that they'll be getting synthetic exposure rather than necessarily directly investing.
Yeah, that was the narrative everyone been trying to sell,
MSTR as well. They have a bunch of synthetic products. They have Stretch as well to get like 10% the yield.
Okay.
So I think we'll see more institutional products that are more public markets facing, that underlying they have DeFi, but on the front end user interface, they're a stock.
Okay. And sorry? Yep.
No, nothing.
Do you want to add anything?
No.
Okay, so since we're speaking about all this stuff, and so it seems that there are some maybe unanswered questions, or maybe on some topics, institutions and DeFi just don't align well. Do you think that this somehow affects how capital is deployed, actively or passively, or is it just irrelevant? Anyone?
I personally think yes, without solving smart contract risk, custodian solutions, including KYC, ML, I think institutions might prefer the passive liquidity strategies.
Just
where
to be
they
on the
can,
safer side.
Yeah, they can go to like regulator-approved custodian and earn basic yield on top of it.
Awesome.
Yeah, but from the other side is when this time would come for the institutions to go into the active management side, the market might be oversaturated at this time, so they might not see those kind of yields which are happening currently, right? This is kind of like a risk premium which exists in DeFi, and yes, there are certain risks, but you get a certain rewards, and this is why we got a lot of institutions who are playing around already. Institutions, even sovereign funds, are exploring this area because there is a quite unique risk-adjusted return which they can get, but at the same time they should accept all the risks.
Okay, I have a totally different topic over here, but I think it's an interesting one. We discuss it quite often. So there is a thin line between supporting liquidity and influencing price. How do you think about that? Is it possible to define this line, and so on? Alice, please, go ahead.
Sorry, your question is the thin line between price and
Do
liquidity.
you think this line exists? And if it does, how can you define it?
I think this line exists, definitely exists, but it can be somewhat blurred. So say, for example, if this investor has a large chunk of allocation that they want to put into a smaller cap token, by putting that all into ones, it can actually push the price up, right? And this investor becomes the market, right?
Yep.
But I think that this line can actually be somewhat blurred if they have the right access to the right shop or execution strategies, right? Instead of just going all in through vanilla spot, you can actually look into some algo trades, right? VWAP, TWAP, where you break down large orders into micro orders. That way, then it limits that slippage, right? So if you're able to have that access and that knowledge, this line, I think, can be blurred. But obviously, it still exists. Yeah.
Yeah,
Link, please.
I would
Okay.
say if you do become a big position in a pool and you're providing a lot of volume, you become a market maker. Some of our investors in our group have accidentally become market makers. One of our investors was putting Bitcoin into an RV pool to basically borrow gold against his Bitcoin, and I think he exceeded the pool. So you can mistakenly become a market maker, and when you are a market maker, you do have influence on the price as well and the performance. So you do have to be careful as well, not to dump the pool or dump the token either. That as a market maker, you have a privileged role that you should be acting in as best interest as possible.
From market maker's perspective, I think the line is your intention, right? So as a market maker, we provide liquidity for tokens by being on the order book on the both sides to observe the natural flow from the buyers or sellers. So we don't intend to influence price. But some active players on the market, they clearly have a price target, either up or either down, and they try to use their position to influence the price on purpose to get to closer to his target. Yeah.
Yeah, I think it's quite thin line between those two definitions, and it's quite easy to impact the price actually, because honestly, even the smallest buy or sell order, it already impacts the price. It already impacts the whole market structure. It just might be noticeable or might not noticeable, depending on the liquidity, of course. And sometimes it's not even the price. Sometimes it's just some social activity, or the thing that, for example, we came all here just to discuss this topic. It's also kind of like a proxy for supporting the crypto markets, etc. So yeah, I believe it's quite a tricky one.
Okay, thank you. We have just a couple of minutes left, so my last question is, I'll put it broadly, but feel free to answer in details or broadly as well. So are you expecting, or would you would love to see any single change which will be good for crypto markets in this cycle or next cycle? Just one thing. Kingsley?
I would say AI agents will bring more products, so more selection, more builders into the space.
Okay.
So I think we'll see more types of products that we can use.
Why do you think? Because of the number of the products?
AI agents reduces the cost to produce. So
okay.
If you see Hyperliquid, they only have 11 people on their team, and so you'll see small teams that are building big platforms, and I think that's very good for the space.
Lingling?
I think personally I want to see liquidity aggregator and chain abstractor. So because right now there's too many fragmentation across L1, L2s, or DSEX and DEX. I think personally I want to see crypto, when you trade in crypto, become as simple as trading traditional assets. Just one click, all the liquidity comes.
Awesome.
I think for me is having even more seamless integration from the traditional side with crypto, potentially even on the DEX side. Currently, we're seeing that a lot already, but I think the coming year would be crucial if we are able to draw more of that new money from the traditional side through a more seamless experience and journey.
Yeah, I totally agree with this point. So basically, I'm quite excited for the TradFi and DeFi merge, because all of us know that DeFi unlocks a lot of use cases and a lot of usability for TradFi, and I think as soon as TradFi and institutions would realize this, it unlocks a lot of value for all of us.
So basically, to combine it, what we're expecting is that if AI agents will work on the combined or unified liquidity and which will provide seamless experience to our users, and traditional investors will understand that. It'll be our bright future, right? Awesome. Thank you, guys.